of selling. But overall, you know, when we look at this, the upside target for silver is pretty substantial at this point. If we take a look, you can see we could see silver run all the way up to about $67 per ounce, which would be obviously a couple big green monthly bars. And I like to use silver for this analogy, which we need to be aware of. Because when things that go straight up in price in a parabolic kind of bubble phase, they tend to come straight back down. So let's just go all the way back to the last bubble that you even talked about way back here. You know, you got to be leery. You got to be a little worried when things go straight up like this. And everybody seems to be wanting to move into it at the same time. If we take a look at the chart of gold, this is the daily chart. Obviously, we've had this kind of blow off phase, a short-term kind of momentum move to the upside where a lot of people piled in. Now, gold kind of had this feeding frenzy of, if you weren't long gold these last kind of 6 or 7 trading days, you could cut the air with a knife. It was so intense that if people weren't in, they had to get in. And we could see it on the charts. We could see it with our custom indicators. There was just a lot of FOMO. And I was warning, we've got to be ready, because usually when we hit this level of FOMO, we need to expect a sharp pullback. Now, it doesn't mean gold is topped. It just means we need a little bit to let a little air out of the bubble and to dissipate. And that's what we've seen right now. So we've seen gold pull back, silver, miners, platinum, palladium, all of them. But to me, it's actually just the first pause and pullback within this a much bigger move. I do think we're going to see gold end up rallying to roughly $5,100, $5,200 an ounce over the next probably 1 or 2 months. I think it could be very quick, depending on how things unfold. So, you know, a lot of people, it's funny because we hit a measured move target right over here on gold, and we closed out a very short-term trade. Now, we were just trading an ETF just for this explosive momentum move. And when we got out, everyone wanted back in because the market kept going higher and they felt like they were getting left behind. Now it's interesting because I actually like gold down here, but people don't want to get into gold. They think it's top. They think it's pulled back. There's been a lot of damage. So that to me is a contrarian indicator. When everybody wants in, you got to be aware that we might have a pause or pullback. And then when other people don't want in anymore, that's usually when it's going to find a bottom and rally. So I like gold here. I think it's trying to still stabilize. As you saw, Elijah, that 1 day drop in gold, it was like a 5% move. Biggest move in like 3 decades for gold in a single day. So that created a lot of fear, and that fear's still in the market. And we kind of continue to see this trickle of selling in both gold, silver, platinum, palladium, and miners. And we're just going to let that fear finish. So let that kind of dissipate. And then I think that pressure will relieve. And then I think we're going to be off to the races to another big leg higher.
Many investors now assume gold has peaked. They believe the setback signals the rally's conclusion, but periods where enthusiasm vanishes often create the most favorable long-term entries. Oversold conditions are developing across multiple precious metals: gold, silver, platinum, palladium, all unwinding excessive optimism. Analysts calling for gold to reach $2,100 to $200 within months emphasize that the pause is typical before the next leg higher. When crowds run away from an asset that retains strong fundamentals, contrarians usually take notice. The market just needs fear to fade. Once confidence stabilizes, momentum can return swiftly, rewarding those who stayed calm.
Well, if we take a look at these two charts, the one on the left over here is the 2007-2008 stock market top. We saw the S&P 500 hit an all-time high. We're kind of at that level of right now where we are on the right-hand chart. The S&P 500 is at an all-time high. What we've also seen here is this yellow line is the chart of gold. Now, gold and stocks have been rallying for the last couple of years substantially to the upside. It's the same where we are right now in 2007. When gold rallies, as you and I have talked about in the past, Elijah, we got to be aware something big and bad is brewing that we just don't know what it is, and we don't know when it's going to happen. But gold is generally a warning sign that there's going to be some big change in the economic kind of cycle, and potentially the stock market cycle as well. So what's interesting is if we look at the chart from 2007, the stock market started to show some weakness. We started to get some red bars, which we're starting to get some red bars where we are right now. But if we take a look what happens to gold in the stock market, so the stock market starts to struggle, stock market starts to sell off. And what's happening here, I think, is money is moving out of stocks And it's always looking for a return. Money is looking to make money. So that money is coming out of equities and it goes into gold, which is why we see gold shoot higher. And gold ends up having this very big rally. Rallies about 30+% to the upside, while the stock market actually sells about 20% off. So that's a pretty interesting scenario. Now, if we kind of go back and look at where we are right now.
Gold rising alongside record-setting stock markets isn't normal. This pairing has only occurred before major turning points, most notably ahead of the 2008 crisis. When stocks capped out then, red warning signals appeared slowly, just as gold accelerated. Capital left equities in search of safety and surged into metals, sending gold up more than 30% while the S&P 500 fell around 20%. Today's charts look eerily similar, stocks marking new highs while gold climbs even faster. Smart money often rotates early, long before headlines reveal what's wrong. Gold's strength may be telling us that the economic cycle is shifting again.
Look at these other layers of the precious metals space. So these charts below is the chart of GDX, which are gold miners. We've got silver, platinum, and palladium. And we just had this first wave, this feeding frenzy of everybody wanting to get into gold miners. They all wanted to get into silver, platinum, and palladium. So now the precious metal space isn't kind of a sleeper. Now it's actually got the masses starting to move in. And this is the first pullback. Now what's interesting is, if we just fast forward a little bit, we see the markets all cool off for a few weeks. This is a weekly chart of all of these. So, for about a month and a half, they cool off. And then what happens is the stock market tanks at the top, and gold, silver, and the whole precious metal complex, they all shoot higher dramatically. They all go higher by about 30 to 60%. All of the different commodities here. And so if I was to just scroll back to where I think we are right now in this market, where gold's starting to pull back a little bit, we're having gold pull back where we are right now. Take a look at the same charts. We have the whole wave of people moving into miners, platinum, palladium, platinum and palladium here, all down below. So we've had this first wave. And I believe if we were to scan forward to where we are, I think we are going to see all of these have one more big push higher. So this little hiccup in gold right here, I believe is the little hiccup in gold where we are right now. I think we're just seeing this first little bout of fear and panic, and it's pulling a little bit of money out of precious metals and things, but I think we're about to see another big push higher. So that's kind of what what the charts are pointing to at this point.
Not only gold is attracting attention, miners and industrial metals have surged as well. Silver, platinum, palladium, and mining stocks recently enjoyed a wave of speculative buying as investors searched for leverage to rising gold prices. The present pullback mirrors past cycles where enthusiasm cooled briefly before explosive rallies resumed. In previous market tops, metals gained 30–60% as stocks struggled. We appear to be entering the second wave of that pattern, where early buyers are joined by larger institutions and global capital flows. Precious metals are no longer ignored. The crowd is watching and preparing to chase.
I think most of the selling is over with. I do think we could see it pull back a little bit more. So using Fibonacci retracement, which you and I have covered many times, a very, very powerful tool. Fibonacci sequence is in the universe. It's everywhere. It really is, to me, one of the ultimate tools to get an idea of where price could pull back to and also where it could run to. And that's how I really get most of my targets. Now, if we use Fibonacci retracement from the May low, from this giant bull flag pattern, to the high that we saw recently and where we are, usually the market wants to pull back into this sweet zone here. This is a 38% retracement or pullback from the high, all the way down to about halfway of that move. So we have already seen gold kind of tag this level. It's already touched that 38. The question is it going to kind of drift down a little bit more and scare out a few more investors before it wants to turn that corner and go higher? So there is potential for it to work itself down and create a lot more fear and create a bottom here. But overall, it's done most of the downside, I think, is done. If we were to look at this from a percentage standpoint, there's potential for gold to pull back another 3–5% potentially if it was to push that to the max. Now, the nice thing about Fibonacci is even if it comes down to this level or has bottomed, we can project where it should go next. And that's going to be based off this last run, the cycle low to a cycle high. and we can come down to the current pullback that it's had, this will tell us where gold is likely to move to. So it's telling us we should see the first rally to about 4,600, 4,700, and then it'll go up to about $5,100 per ounce going forward. So there's a pretty nice projection. Obviously, if gold gets some traction here, it could really pick up speed and go parabolic and give us, on the monthly chart, a couple huge green bars to the upside going forward. So that's kind of my take on gold at this point.
Price movements often follow predictable structures rooted in Fibonacci ratios, patterns found in nature and financial behavior. Recent declines have brought gold into a historically significant support zone, a 38% retracement from its latest surge. This suggests only limited downside remains, perhaps just a few additional percentage points at most. From here, projected targets cluster around $4,600, $4,700, with a potential extension toward $5,100 if momentum accelerates. Silver shows similar geometry, a possible short dip toward $42, $43 before a rally toward 65 plus. However, parabolic rises can reverse sharply, so disciplined planning remains critical as volatility increases.
If we were to kind of take where I think silver could pull back to, now I'm not going to use this particular sharp drop that we had. I think if we were to look for a retracement in silver, it has tagged the 318 level. I do think it could potentially work itself down to maybe even, $42, $43 an ounce if we have one more little bout of selling. But overall, when we look at this, the upside target for silver is pretty substantial at this point. If we take a look, we could see silver run all the way up to about $67 per ounce, which would be obviously a couple big green monthly bars. And I like to show you silver for this analogy, which we need to be aware of, because things that go straight up in price in a parabolic kind of bubble phase, they tend to come straight back down. So let's just go all the way back to the last bubble that you even talked about way back here. You got to be leery. You got to be a little worried when things go straight up like this, and everybody seems to be wanting to move into it at the same time. If we were to look at this and say, hey, where's that $67, potential upside, we could still see, very big, huge spike to the upside in silver, a couple big green bars. We just need to be aware when things go straight up like this, they can come back down very quickly, and then they need to build a new base. So that's kind of where we are. I think there's quite a bit of upside in silver in miners. From there, I think eventually we'll see it pull back to some regard. It'll build a new launch pad, and then I think we're going to go a whole lot higher. In fact, I think it'll be something similar. Let me just go back to 2008. I think it'll be the same for gold and silver, whereas silver had this parabolic move. It shot up just before 2007 market top. And then we saw it pull back about 60+%. Well, I think we're going to see something similar to that, because I think if we see it rally up and we go into a financial reset, then I think we're going to see it pull back fairly substantially. And then from there, I think it's actually going to start a new rally that could send it way up into the 80s and the 100 mark going forward. And if I was to kind of just drop back to gold for this scenario as well, I think gold would eventually find a top here, and then it would pull back into a consolidation zone, just like in 2008. It pulled back about 34%, and then it goes into a multi-year rally. So then after that, I think gold could be up in the $8,000, $10,000, $12,000 mark. But there's a roller coaster ride between here and then, right? I think we're going up a hill first, and then we're going to go over the edge, and everybody's going to scream for a little while, and then it'll stabilize, and then I think we go up for a much bigger ride. So I'm bullish on gold and silver long term. Short term, I'm bullish, but if you look forward, like over the next 6-8 months, they might be back where they are right now, or they might be a little bit lower. So long-term investment wise, I mean, it's still a long-term play. Short-term traders, I think, have got potential for another big push to the upside.
The current advance may be just the first stage of a far larger transformation. Analysts envision a path similar to the post-2008 world: a sharp rise, a daunting correction, then an extended secular uptrend. If a global financial reset occurs, gold could eventually trade in the $8,000, $12,000 range, with silver surpassing $100 in later years. But the journey won't be smooth. Expect a roller coaster, breathtaking climbs, fear-filled drops, and immense wealth transferred to those who understand the cycle, not fear it. Short-term traders may benefit from momentum. Long-term believers may benefit from history.